Prateek, morning. Thanks for your time. Prateek, what's your observation right now as far as the valuations go? I mean, the call that valuations are on the stretching side is getting higher, and the markets are making fresh records high every day.
No, so a few points. While we do share some bit of the valuation concerns that are being spoken about, so no two ways about it. But point number one is if there is a time when valuations should be theoretically higher than long period average, I think is now because three things which go into valuations: free cash flow, growth, and discount rate. So free cash flow is higher than usual, growth is higher than usual, and discount rate when the next rate move is down. So that is again favorable. So I think valuations should be expected to be higher than long period average. Now, we did some work, and if the higher growth sustains for 10 years. 1% higher growth sustaining for 10 years is a 5% increase in DCF. So one has to work with that kind of a thought process. So when times are good, numbers are coming better, outlook is good, then to expect valuations would be, average and below is not right. Valuations would be higher than average. How much? I just gave you the ballpark to work with.
Okay, so that's the Nifty. Valuations will be high. But there are defense, there is railways, there are PSU stocks where valuations are not above historical averages. Valuations are way. I can add another way above averages.
No, so agree there. We should see some amount of consolidation there. But then at the same time, while valuations are way above average in these spaces, growth is also way over average in these spaces. But that said, these spaces could do with some amount of consolidation. Now here again, 1 quarter, given the way it is, I'm not talking one small segment, but generally speaking, 1 quarter of consolidation is a 4% correction in valuation in large cap, 5% in mid, 6% in small. And with it, if you get 3-4% correction in prices, it's a 10% correction in valuations over a quarter. So that is the other thumb rule one can work with. Now, this is different from 2008 to 21 period, because in that period, the growth in earnings compounded was just about 5% on large cap, mid and small were lower. So it was 1% a quarter earning correction that was happening. So a lot of the valuation correction had to be all markdown of prices. Now it can be a combo.
My point is on the market, and I just want to draw your attention to what has happened after the budget. What has changed for this market? Sorry, after the elections, I beg your pardon. What has changed after the elections that we've seen a linear rally? Is it pure money on the sideline which is coming back? Has anything changed on risk? Why have we seen such a linear rally in last 1 month per se?
No, so we have to go slightly backwards. In between Feb and April, Chinese market moved 30%, and that's the largest emerging market. And when it moves, it draws money from all other emerging markets. Okay, what has happened after that is that market is now gotten back into the consolidation phase, and the FPIs which were moving money to that market are, let me say, staying put. So, you have a construct where FPIs are no longer selling and domestics keep buying, resulting in, what you are seeing just now in the markets.
What is the best way to approach this market? I mean, stay invested, raise cash. I'm getting a very contradictory view from even, veteran fund managers. There is one view which says that, look, we need to book some profits. There is a view which is coming from you right now, which is that, look, the terrain is different, so obviously valuations would be different.
No, so just to reconcile, I think for so the task for us managers and the task for investors are different. We compete with the index, okay, at the minimum. The investors don't need to, they should work with absolute. And for them, if they have an asset allocation plan, they should stick to it. So if, just because of the move in equities are looking heavier in their portfolios, I think as a discipline, you should take some money off the table and go to other asset classes. Believe me, it works.
Okay. Where are you finding spots of opportunity and where are you finding spots of excesses in this market?
So I'll tell you, we are growth investors, sustainable growth investors. And on a relative basis, the highest growth part of the market offers competitive advantage versus the index is the thought. So, all the highest growing spaces, it could be renewable, it could be new tech, it could be, you get the drift, EMS spaces, etc., are where, the growth quotient is very high. And if you compete with the index, I gave you some ballpark numbers on 26 kind of earnings, even on PE these spaces will seem to offer relative upside,
Give us.
relative outperformance, should I say.
Let's get in a sense then as to what the outlook is when it comes to the entire EV space, given the kind of commentary we've had from the auto majors just very recently. Why do you believe that there is more potential within EVs?
I said EMS renewable kind of spaces. No, so EV, yes, so we are invested into businesses where a company may have not done as well on the ICE side and have a much better chance of doing well on the EV side. Every disruption hurts the incumbent way more than the and gives opportunity for a new leader to emerge. I think we are seeing that happen. So now the call is whether over a period of time EV dominates or ICE continues to have a very significant market share. Our thought is that over time EVs would end up dominating, and hence our portfolios are nearly zero on ICE. They are with companies where they haven't made such a large success of ICE, but have a great potential of making it in the EV space.
Prateek, renewables, which you just briefly mentioned, has a wide variety of options. You have renewable financiers, which according to some are actually much higher valuations now. Then you have renewable OEM guys, renewable, wind turbine companies, etc. Which part of renewables do you like, or even renewable, chemicals? So, which part of renewables do you like most?
We like renewable chemicals. We like the wind guys. Solar guys, the choices are very low and seem to be mostly in the panels space where entry barriers are not there. Frankly, we miss the financiers completely. But that is how it is. So chemicals and wind guys is what we still continue to like.
Okay. Pratik, there is a view which says that IT is turning based on the evidence what we've got from, let's say, HCL Tech and TCS. Is there merit in assuming that, look, worst is behind us, the best is not yet to come, but if the turn happens for a sector like this, it's going to be a large turn and which could ensure outperformance comes back?
So there was a time when IT and should I also add banks were profit leaders, profit growth leaders. That time is behind us. Now, if you are a growth focused investor, if the index is supposed to do 13, 14, 15% growth, IT will be, 8, 9, 10, 11%. So it is behind. Banks are just about index getting behind. So for us, large cap IT, yes, for risk control, you go there if the sharp up move is expected. Else we stay away where we are finding a lot of our managers are interested is mid and small cap IT, where a company, if it is focused onto space, which is growing well, I think the growth delta over large cap is very high. So after a long while, for last 2-3 years, we are seeing that mid and small cap IT delta growth over large cap is very high. That was not the case, let's say, before.
Prateek, how are you approaching the entire auto and auto ancillary story, especially auto ancillary actually, because a lot of them are, kind of evolving their business models.
Yeah, so we as a house, like auto ancs, it is less represented in the portfolios because ultimately the growth quotient that you are seeing there is in the vicinity of 20%. But yes, there are 4 or 5 auto companies that we are invested in as a house. And those 4 or 5 seem to be doing well, winning market shares, getting into newer spaces. So in auto anc, if I give you the structure, if you are with one vendor, that vendor grows at 7-8%, you will grow at 7-8%. So the way to grow faster is to add new capabilities and add new OEM customers. People who are able to do that attract attention. So, 4 or 5 companies in this space is what we are clued on.
All right. Thank you so much for taking time out, Prateek. Good chatting with you and getting a sense as to what you make of the market, valuations, as well as individual sectors.
If you like this video, then like, share and subscribe to ET Now.